You see it all the time, right? You glance at the news, and the price of gold has either shot up or taken a nosedive, and you're left wondering, what on earth just happened? Well, it's one of the oldest mysteries in finance, and today we're going to pull back the curtain and figure it out together.
So, what is it that makes the price of gold swing so wildly? It really does seem like it's reacting to these invisible forces moving through the global economy. But as you're about to see, those forces, they're not nearly as invisible as you might think.
See, the price of gold isn't just a number on a screen. Not at all. It's this incredible story that weaves together the physical reality of how much gold is actually out there, the massive world of global finance, and maybe most importantly, the powerful and sometimes kind of irrational psychology of human fear. To really get this, let's start at the most basic level, the physical world. Just like with anything you can buy or sell, from oil to coffee, the price of gold starts with good old-fashioned supply and demand. The idea here is really simple. On one side of the scale, you've got supply. That's all the new gold being dug up from mines, plus all the old gold being recycled. And on the other side, you've got demand. This comes from all over. People buying jewelry, companies needing it for electronics, investors like us, and even the world's central banks. When demand starts to outweigh supply, yep, the price goes up. But this is just where our story begins. The thing is, gold doesn't live in a bubble. Nope, it acts more like a super sensitive barometer for the entire global economy. It's constantly reacting to the economic weather, so to speak. So here's a really crucial point. When your money, your dollar, your euro, whatever, starts to buy less than it used to, inflation, people get nervous. They start looking for something that's going to hold its value. And for thousands of years, that something has been gold. So as the buying power of our money falls, investors tend to rush into gold to protect their wealth, and that pushes the price higher. This brings us to something finance folks call opportunity cost. Gold has one big drawback. It just sits there. It's a rock. It doesn't pay you interest. It doesn't pay dividends. So when interest rates are high, you can get a nice, safe return from a savings account or a government bond, which makes holding gold look, well, kind of boring. But what happens when interest rates are practically zero? Suddenly, holding a non-yielding asset like gold doesn't seem like such a bad deal after all. Now, this is a huge piece of the puzzle. You gotta get this part. Almost all of the world's gold is priced and traded in US dollars. And that creates this really special, really powerful relationship between the two. Just think of it like a seesaw. On one end, you've got the US dollar, and on the other, you've got gold. When the dollar is strong, it takes more euros or yen or whatever currency you have to buy 1 ounce of gold. That makes it more expensive for everybody else, which can lower demand and push the price down. But when the dollar is weak, the seesaw tilts the other way. Gold suddenly becomes a bargain for anyone outside the US, and that flood of new demand can send the price soaring. Okay, now we get to the real wild card, the most unpredictable and maybe the most powerful driver of all. Us. Human emotion, group psychology, and the big strategic moves made by huge institutions. This is what can cause those really dramatic price swings. You hear this phrase thrown around all the time, right? Safe haven asset. Well, gold is the textbook definition. It's the classic example. When everything else in the world seems to be falling apart, investors look for a port in the storm. I mean, just think back to the 2008 financial crisis. Stocks were plummeting, but gold prices were surging as people scrambled for the security of something real, something tangible. So, what is it that sparks this flight to safety? Well, in a word, fear. When a war breaks out, or there's a major political crisis, or the stock market is just going haywire, that uncertainty sends investors running for the perceived safety of gold. This fear factor is a massive driver of demand. And we're not just talking about regular people and individual investors. The real heavy hitters in this game are the world's central banks. They hold these massive reserves to back up their own currencies, and they often buy huge amounts of gold just to diversify away from holding too many US dollars. So when a country like China or India announces they're making a big gold purchase, that sends a powerful signal to the market and can seriously boost global demand. So as you can probably see, there isn't one single on switch that sets the price of gold. It's much more like a complex, really dynamic dance between all these different forces pushing and pulling at the same time. So let's just quickly recap the 3 big layers we've peeled back. First, you have the physical nuts and bolts of supply and demand. Second, you have the big picture economic conditions, things like inflation, interest rates, and the value of the dollar. And third, you have the powerful and often emotional influence of human psychology and that global fear factor. They all work together. It is absolutely crucial to remember, though, that even though we call it a safe haven, investing in gold is not a guaranteed one-way ticket. Its unique nature actually makes it vulnerable to some pretty unique risks. So what are we talking about? Well, first, the very same geopolitical events that can send prices soaring can also cause them to drop like a rock. Its price can be extremely volatile. Second, you have a lot of speculation in the futures market, which can basically amplify all of those moves, up or down. And finally, there's that opportunity cost we talked about. During calm economic times with high interest rates, holding gold can mean missing out on some serious gains somewhere else. Which kind of brings us to our final big question. Is gold's value really intrinsic, a true timeless store of wealth that protects us from chaos? Or is its price just a mirror, reflecting back our own collective anxiety and fear about the state of the world? The truth, as we've seen today, is probably a little bit of both.